it's everyone connected now. José Manuel Campo is already with us.
Yes, good afternoon. How are you?
Good afternoon. It's a pleasure to have you with us.
Thank you for the invitation.
No, it's our pleasure.
Hi, José Manuel.
Hi, Gabriel. Hi, Steven. Hi, Pedro. How are you?
José Manuel.
Pedro, I'll mute my sound, so sorry, the ball is yours to conduct things.
Shall we start?
Just an extra minute, but I think we can start.
Oh, maybe before just we start, so as discussed, I will then maybe have 2 or 3 rounds. If you could be concise in your answers as we agreed in our exchange.
5 minutes.
Particularly you, Gabriel.
Yes, please. 5 minutes.
Okay, so I think we can start. So good afternoon, and it's a pleasure to be here moderating this session. I think it's a pity for all of us not to be in Lisbon, but hopefully next year we'll have the opportunity. But what matters is that we are able to still do the conference. So it's a pleasure for me to moderate this session and to thank Professor Luís Moraes for the invitation. We have the 3 chairs of the European Supervisory Authorities, which is quite a unique setting. In order to make the best use of the time, since we have now only until 3:30, maybe I will start immediately with our discussion. And of course, I mean, it has to be about what we are all suffering now, the pandemic crisis. And I think all of us in our careers maybe have managed too many crises, and this one is clearly the most challenging of all. From my personal perspective, I think that one of the common denominator of the crisis for all your 3 financial sectors is that it shows and exposes and even exacerbates some of the structural weaknesses that we have in the single market for financial services. And this includes, I mean, like Stephen has been talking about, the absence of a capital markets union, the absence of a European deposit insurance scheme, the absence of European safe asset. And I think still we see that many obstacles to cross-border integration are still present in the insurance, securities and banking businesses. So now, in order to have a deep dive on the consequences of the crisis, we'll have first several questions, but my first question for a concise answer is what will be your top concern, what is now your top concern regarding the impact of the crisis on your respective sector? Maybe alphabetically, if we start with the banking sector, with José Manuel.
Thank you. Thank you very much. First of all, thank you, Pedro, and thank you to Luis and the organizers for inviting me to be in this panel. It's a real pleasure to be here with you today. And you asked me, what's my top concern? I would say that the top concern will remain, with a banking sector that is performing its role properly. Mainly that it adequately provides credit to the economy and channels savings to investment while providing proper services to the customers, the EU citizens and corporates. I think it's fair to say, you highlighted a number of shortcomings that we have as a European Union and that are showing in the crisis. But I think it's fair to say that the first 7 months have not been, the judgment of the first 7 months has not been too negative on the European financial sector, and particularly banking. I think that the role that banks has played has been overall performed very well in the last 9 months as we went through difficult times. This was due to actions by the banks took in the first place and their operational resilience, but also to a lot of the regulatory changes and enhancements that have been done since the last financial crisis to beef up the sector. The very significant actions from the fiscal and the monetary authority sides have also helped a lot to maintain the situation. And I think it's fair to say that a simple assessment so far is that the financial sector has contributed to dampening the impact of the health crisis and into the economic outcome. and that so far has been able to perform its role in a good manner, and that we hope to go forward, that will be the same. Now, you ask, what can we expect as the current biggest progress is? Well, the biggest challenge is what should we expect as the ongoing impact materializes into the banking sector. There's still a lot of uncertainty, but we should expect that the large economic deterioration, despite the measures that I mentioned before that have been put by fiscal authorities, and also, will materialize eventually in a significant number of firms and individuals with financial difficulties as a result of the crisis. So banks need to continue the proper assessment of the credit quality of their portfolios and the evolution over time as the situation evolves of that assessment and that credit quality, and actively manage it, by addressing the need of customers, but also by timely recognition of likely losses and active management of the non-performing positions as they materialize, which I expect that they will continue to materialize going forward. We're already seeing a slight increase in provisions, a slight increase in stage 1 and stage 2 non-performing loans in the IFRS 9 context, but we should expect that will continue to happen in the future. So we'll be monitoring this very carefully, and more important, we'll be performing a stress test that we were in the middle of performing in the spring. Last spring, we'll be performing it in the next 6 months, the first 6 months of next year, I should say. Hopefully this exercise will be performing in an environment where we'll have a better visibility of the outlook, of the economic outlook for the health challenge as well. And as a result, we'll have a better assessment of the overall stability. But in any case, the stress test should help us to identify the overall status of the industry and to better plan at the individual level for each individual bank the best way to pursue further assessment. Beyond the short-term management, I kind of expanding that later if we want to. I think there are also underlying weaknesses in the banking sector that have also been not just in the structural setting, institutional setting, but also the banking sector itself, that have been accelerated as a result of the crisis and that need to be addressed going forward. Let me stop here for now. Thanks, Pedro.
Thanks very much, José Manuel. Gabriel?
Yes, thank you very much, Pedro, and thanks to... It's a pleasure. Muito obrigado pelo convite. I need to say something in Portuguese, of course. No, the top concern from our side is definitely, what will be the effect when all this economic situation that we see unfolding right now will be more crystallizing. And until now, let's be honest, the insurance sector has been, maintained a sound position, has continued to deliver on the long-term savings, on the protection of households and the economy. So this is also because of the fact that we had Solvency II implemented, which is really a risk-based system that contributed to have, good levels of and ratios of solvency. But of course, the challenge going forward, and we should not be complacent, to be very honest. The challenge is to see when the really economic effects will be impacting the sector. And what we have in the insurance sector is what we tested, this kind of really difficult scenario, what we call a double hit scenario, where insurers will be on the asset side and seeing, of course, the value of their assets going down, but also then their liabilities increasing due to, of course, the low interest rate environment. And so that's really the scenario that concern us more. We believe that a full impact in the economy is still to come. Corporate debt, which is one of the big holdings of insurers, will be, of course, further stressed. Credit downgrades, credit defaults will probably continue to happen, and probably it will raise. Commercial real estate exposures and the valuation of commercial real estate, it's also under stress, after COVID with the remote working. We'll need to see what are the cliff effects from, winding down of the fiscal and state supporting measures that were there. And let's not forget also, the effect that all these crises will have in the medium term in terms of the levels of indebtedness of member states, and then of course the effects on sovereign spreads. And that insurers have, of course, a huge exposure to sovereigns. If you add all of these to the equity market volatility, and also to the interconnectedness that many insurers and insurance groups have with banks, and what José Manuel mentioned, of course, the future effect of NPLs in banks and the potential for contagion that will also bring to the insurance assets, I think that's a very stressy situation. Then when you look at the liability side, insurers are obviously hugely affected by the situation in interest rate risks and the massive central bank interventions. And we will see, of course, what happens still this year on the monetary policies from the ECB side. What we look now, when I was looking just at the last euro swap curve, and it's impressive. It's now negative up to 20 years maturity. So you can imagine what is the impact that this has, of course, when you discount liabilities in the insurance sector. This increases tremendously the level of provisions. And I think we should, there was a lot of discussion if we were in a low for long scenario or not. I think that now we are definitely. But to be honest, I think we should start to call it, more a negative for long than a low for long, because the negative for long is really the reality already. So if you combine these effects on the asset and on the liability side, you will have, of course, a huge stress on the own funds with the reduction of own funds, and this can, of course, put at risk some of the levels, capital levels, and solvency levels in the sector. That is, of course, the major concern from our side. And that's why we believe that we cannot be complacent. We need to continue, of course, to do preventive supervision and to make sure that companies continue to manage risks in a proper way, that they take initiatives also to preserve capital.
Thanks very much, Gabriel. Stephen?
Thank you, Pedro, and thank you very much also to Luis for organizing this event. And said many times before, being in Lisbon, probably it's one of my favorite cities, top favorite cities in Europe, and it's really unfortunate that we cannot be physically there, not only to meet you, but also to enjoy Lisbon itself. And let's hope that the optimistic signals around vaccination will materialize, and that next year we can indeed meet each other again physically in Lisbon. Very briefly on securities markets. So I think it's fair to say that comparing this crisis to the global financial crisis, while in terms of negative impacts on markets, on valuations, it's comparable indeed to the global financial crisis. Instead of developing over 1.5 to 2 year time period, it was now compressed in a few weeks. And so it's been extremely volatile impact on the financial markets. I think generally they have responded adequately. We are satisfied with what we have seen, for example, with market infrastructures, with trading venues, with CCPs that are especially impacted by volatility. Mass number of transactions that had to be coped with by trading venues. But that has worked generally well. I think where, as I just said, the most of the stress this time was in the non-banking sector, more so maybe than in the banking sector, which was basically the core of the focus in the global financial crisis, together with the sovereigns. Now the very strong focus on the non-banking sector, and within the non-banking sector, a strong focus on asset management. I think there it's important to disentangle, let's say, generally open-ended funds vis-a-vis money market funds. Open-ended funds, although there has been an increase in use of liquidity management tools, obviously there were liquidity concerns, especially in corporate debt funds and real estate. And the number of the use of liquidity management tools was clearly more than average. I think generally the open-ended funds have reacted adequately, although we have also seen that there has been cases where individual funds didn't properly manage, let's say, their liquidity profile compared to the obligations that they have vis-a-vis investors, in terms of how frequently can they ask for redemption, and how long is the notice period to ask for redemption. So there, although by and large it has worked well, I think there are specific areas that require both the attention of the funds themselves, but also of regulators. The area where we are much more concerned and where the stress levels were clearly the highest in asset management relate to money market funds. Money market funds were both under stress, let's say on the liability side, because of the dash for cash, investors wanting to cash in on their units, their ownership in these money market funds. And on the other hand, short-term markets, asset markets being under pressure, being frozen, and it is clear that the money market funds basically made it because of the central bank intervention that eased the situation in short-term markets. At the same time, I think we should not have a model of money market funds where we would assume central bank intervention. And so that is an area where we need to look further. It's an area where further reform is needed. And I think that is a discussion that we need to have in the months ahead. I think the two areas where my current concerns are is, first of all, as it's called, the decoupling of financial markets from the underlying economic situation. Market valuations have been basically restored nearly completely after March, but we know that the underlying economic situation is very difficult, very grim, and that raises concerns around possible other rounds of market turmoil in the days, weeks, months ahead. And so that is a source of concern. The other issue, but I think we will get to that in the next round of discussion, is that, and it's very good, of course, that banks took their role in continuing to fund the private sector. Obviously, what we have seen is that most of the gaps in revenues, the sharp reduction in revenues, have been compensated with increasing debt in the private sector, and the private sector was already indebted before going into COVID-19. And of course, that relates also to a very low interest rate environment, but in itself, it is a concern. And so I would say that the key concerns at this stage, we need to look again at money market funds, the issue around decoupling, and the sharply increasing indebtedness of the private sector.
Thanks very much, Stephen. My take from what you three were saying is clearly that, I mean, so far so good, in the sense that the regulatory regime changes and reforms after the great financial crisis have worked to a large extent. Market infrastructures have worked. The insurance business remains stable and solvent, and same for the banks. But at the same time, that the worst is yet to come, and we don't know when it will come. That's, I mean, the major source of uncertainty, depending not only on the vaccine, but also on the interventions of governments. For example, when they start lifting the moratoria and the support they are giving to the financial system. So I think you gave already a good outlook about what will be and what will be the crisis management mode through 2021. But if we could look then beyond 2021, and at some stage there'll be a recovery mode for our lives and for the economy. So if looking into, we don't have a crystal ball, but trying to look at the post-pandemic landscape, what will be, in your view, the key challenges? Again, also from your experience with the great financial crisis, what is there to rebuild? What will be there to reform? And what will be the initiatives that you would, in a way, advocate for? So maybe again, José Manuel, starting again the sequence.
Sure, thank you very much. Happy to start again. I think that as we look forward, I think that first of all, and this is lessons from the crisis, from our previous crisis, fragmentation is always a risk. We had seen that in the previous global financial crisis. Fortunately, at the beginning of this crisis, we have not seen a lot of fragmentation. Partially, I think it's also, if I give us some credit to the institutional buildup that was done in the European Union, by the presence of the banking union, the three ESAs that we represent, but more broadly, also the ESRB. All these institutions helped in fostering the coordination. I think that was good, but at the same time, there's still a potential risk for fragmentation. That risk from the banking sector, I view it in a number of areas, but more important, first is the need to continue the global coordination, which so far has worked well within the context of the Basel Committee, but that will pose challenges as we go forward, because I fear that the speed, the recovery, and the timing of the recovery is likely to be less coordinated or less coincidental across the world that the shock was. The shock really happened across most of the Western world in the context of about 6 weeks, and that recovery is likely to take much longer in different parts of the world and also of the Union, and that will require a lot of coordination. That doesn't necessarily mean coincidence in the policies, but just coordination. So that's one aspect. The second aspect that we're paying a lot of attention to is the fact that all these fiscal measures that have been put forward, particularly the public guarantee schemes, which are the ones that are more directly linked to the banking sector, are natural in their nature. They're national and they're specific. Sometimes they even differ within countries, depending on the sector or the counterparty or the guarantee that's being provided to the particular non-financial corporate or vulnerable group in society. And that, how those public guarantee schemes work within the interaction of the banking sector and with the need for restructuring, financial restructuring that's likely to happen in many corporates, which, as Steve said, there's been an increase in private credit. Many companies are going to find themselves that they have a financial structure that is not optimal at this stage, that some of that debt needs to be restructured into more equity type of instruments. What will be the play of the public guarantee schemes in that process, and how would that be facilitated in a process that we already know across the union is difficult because insolvency procedures are so diverse across the union. We're in the process now of responding to the Commission, which we'll do by the end of this month, on a call for advice on insolvency procedures across the union, and what we see is large amounts of diversity, in recovery rates, times for recovery of loans, and things of that sort. So how that will play is very, very, very important and will have a big impact on the banking sector, but more important for me, also on the productive structure of the economy and the speed of the recovery. Because if through that process we find ourselves that we're taking too many companies through the liquidation process, that rather than through the restructuring recovery, we might be destroying a large part of the productive capacity that needed, and that's a challenge. And then finally, and this is more specific maybe for the banking industry, as I mentioned before, there were underlying challenges that were there before in the industry, particularly a lack of profitability. The industry was obtaining a return on equity that was below the cost of equity prior to COVID, and with the low for longer scenario, negative for longer that Gabriel was talking about, that profitability challenge will likely continue for longer in the future. There was also the challenge of technological transformation so as to engage in sustainable business models, and that has also accelerated. And I think also for the financial sector overall, this is not just for the banking sector, but we have the ESG challenges which they were there before, and I think now not only they continue to be there, but they also have accelerated. So I think the industry needs to address that. In the banking sector as well, we think there are pockets of excess capacity in different parts of the industry that need restructuring. And to get that orderly restructuring, I know companies are, senior management are engaging in trying to find ways, mainly through cost cutting, which I think is probably the only lever that they can have almost full control over it. But that's going to be a major challenge for the banking sector going forward, I think. So let me stop here.
Thank you, José Manuel. Gabriel?
Yeah, I think that challenge in this post-COVID environment and with the recovery, I believe it's to find a new equilibrium between economic growth and stability and protection of consumers. And I think that is going to be a huge challenge going forward. In the coming up of after the great financial crisis, there was clearly the pendulum and the push more, on stability and on consumer protection. I think that all the work that we have been doing in these last 10 years, also at the ESA's level, has been in that direction, and also the structures that were put in place in Europe with the banking union, etc. I think that we will enter, we were already entering before COVID, let's be honest, but I think now after COVID, we will enter in a completely different paradigm of discussion, where economic growth will be put at as the main, I would say, driver. And I think the equilibrium between that and maintaining the protection and the stability of the markets is fundamental. Now, I think that all of this needs to be put in the context of, I would say, three main priorities, which are the real priorities right now at European level. Sustainability, climate change, the Green Deal on the one side, digitalization and all the digital economy as a second element, and definitely also the capital markets union, and to have a more diversity in funding the economy in Europe. And I think that the key issue is going to be there to see how are we going to effectively translate, both in terms of policy, but also in terms of action, in terms of business strategy, how are we going to translate this new equilibrium coming from the lens of these three main factors. And I think this is going to be very, very much fundamental for what will happen in the next 10 years, because I think that this is transformational. We're not talking about just a normal evolution of regulation or of business practices. This is clearly transformational. So for everybody, for regulators, for supervisors, for industry, this is going to be, I think, a biggest challenge, and it will involve, I think, a huge change of paradigms in various areas. We need to have the capacity to act as a union, as an internal market, because that's the only way really to bring growth through the lens of these three areas. We need to make sure that we have standardization, to have economies of scale, for example, looking at the supply of green projects, otherwise it's going to be very difficult. We need to make sure that the progresses in digitalization will not only deliver trust and confidence and better products and services for consumers, but will also, at the end of the day, allow companies to scale up throughout Europe. And this is fundamental. If we're not capable of scaling up the digital innovation throughout Europe, we will never be capable of competing worldwide. And I think that is really looking at what's happening right now in Asia, in China, and also what the US will do for sure, and now the UK will do also, because that's another challenge. I'm sure that they are betting, and they will continue to bet on innovation in digital, and Europe needs to act together on that. And finally, on the CMU, I think that we really need to grow up to the standards and to the challenge of involving more retail investors in capital markets. I've been pushing for this for a number of years, that we should look more at the demand side of capital markets, to look at pensions, occupational pensions, and private pensions as the real lever of having more long-term investment in capital markets. I think there are some small steps that are being given right now, but these are the real transformational elements that we need to grow up to the challenge. And I want to finalize one element, of course, which is supervision. I think that the consequence of all of this needs to be that we will need to have much more integrated supervision in Europe across the financial sector, not only on the banking side.
Thank you, Gabriel. Stephen?
Well, of course, Pedro, it is difficult to judge how the recovery will look like. And while it is for certain that the coronavirus will continue to be very important in the years to come, it is very unclear, how this vaccination, how successful that will be. Will we be able to go back to normal, for 80-90% by summer of next year? Or will there be new problems when there is this vaccination distribution? It is very uncertain, because we haven't done this as societies before. And so really very, very uncertain to see how that will develop. And obviously, as a result of that, volatility in financial markets will be continue to be a feature, simply because with every piece of new information, we need to reassess very fundamentally how the future will develop. I think one very clear issue, and I hinted at that already before, and also Jose Manuel, is the indebtedness of the private sector is obviously a source of concern that argues for working on the capital markets union. What is very good, and that is the point made already by Gabriel, is that what should be part of the capital markets union is bigger participation by retail investors, either directly or through pension systems. And obviously this all relates to the fact that it will help them to get a reasonable return on their savings, but also having a financial system where equity plays a more important role is also a system that is more supportive of innovative economic activities. It is well known that equity financing is typically better suited and better catered to more innovative, high-risk type of economic activities, and therefore it's important to develop that. What is of course slightly concerning there is that, and on the one hand, it's very good that the European Commission has made a proposal for the quick fix, where there is this idea about how can we help the capital markets to get easier access to the capital markets by issuers, by SMEs. And so what is in the quick fix is legal proposal that is currently negotiated between Parliament, Council and Commission. What is positive there, I would say, is that there are some measures that would ease access to the capital markets with, for example, less onerous requirements around prospectuses, which I fully support. But I should also, it's fair to say that there's some parts of this quick fix which more look like a deregulation agenda where investor protection measures are going backwards. And for example, the issues around unbundling of research and execution, and also the looking again at the composition of the various retail investors, professional investors, how do you disentangle them? I must say we're concerned that not all of this can be well argued from a perspective of easing access to capital markets, but there is also elements of deregulation which I do not support. Two other issues that I finally would like to mention and which will be a challenge. The first one is transparency. It's a point also that that my colleagues, that Gabriel and Jose Manuel have made in the past. It is important to have the right recovery, to have the right restructuring, is that we're transparent on problem loans, is that we're transparent on rating quality and credit quality, is that we're transparent on performance. And so clearly for a securities markets regulator, extremely important that credit quality, that ratings continue to be good indicators of credit quality, and that financial reports based on IFRS are a best possible reflection of the economic reality. And I think that is a challenge. That is a challenge for two reasons. It is a challenge because the underlying economic situation is very uncertain, and also there can always be this tendency to hope for better times and to be too optimistic about the situation. And so clearly that is an area which will be a challenge for all involved. Finally, just to underline, I will not go into that area, but all the comments that were made around sustainability by Jose Manuel and Gabriel fully support that. But let me stop here, Pedro.
Thanks very much, Stephen. If it's possible to summarize such a already rich discussion, my take is that, the challenge is to have the financial sector serving two purposes. First, to avoid having a destruction of the productive capacity of the economy, so that, that we don't have, due to all that is going on, that healthy parts of the economy and productive parts of the economy are lost due to the lack of financing, due to the lack of equity, or due to the fact that also, for example, the insurance funds have to invest elsewhere on one side. On the other side, to try to have the financial sector then financing this transition and also keeping some of the agenda that we had before the pandemic, like sustainability, climate change, digitalization, electrification, that still this remains financed and funded by the financial system. And I think this is a particular challenge because it's clear that a lot of the ammunition that we had, for example, in terms of fiscal capacity of the member states, is being used now with the pandemic. And so may not be available then for the reforms that we all need, such as climate change. And he also pointed to the risks that we have. I think one of the risks is fragmentation or retrenchment back into national markets. And one very clearly by Stephen, the risk of deregulation, that we go back into the reforms just for the sake of having things go back as quickly as possible to normal. Maybe since we have still some time, maybe my next question will be if you could pick a European initiative to have more integration of the European single financial market, what would be that initiative? And why would you sponsor it? And what are the challenges? We know that still, again, the crisis showed that there are many obstacles to cross-border integration in all sectors. Even in consolidation of the banking sector still happens very much at national level. So if you could pick and sponsor one European strategy, one European initiative for more integration, what would be that one? If you need some seconds to think, but you are well versed into that. So maybe Jose Manuel, would you like to start?
Yeah, I'd be happy to. This is relatively, I think there are a lot of initiatives that could help in this process, but it's not, I have to pick one, and I'm in the banking sector, I'll pick completing the banking union. Clearly, I think there we have some progress that needs to be made, mainly partially on the resolution side and mainly the deposit insurance side. I think that, we run the risk of fragmentation, but let's be honest, since the previous financial crisis, cross-border banking activity decline after the global financial crisis. That happened across the world in many jurisdictions. Part of that was highly desirable, But then, over the last 5-6 years, cross-border banking activity started to increase in other jurisdictions, but it did not increase within the euro area or within the EU. I think that's a real challenge that we need to be honest about. We think we made a lot of progress on banking union. I think we have. We certainly have a much better homogeneous, coordinated, integrated supervision within the banking union, but still a lot needs to be done. And as you said, I just pointed to cross-border activity, but you also point to the fact that when we talk to executives in the banking sector and we talk about concentration, integration, consolidation, the issue of cross-border consolidation usually comes up, and they tend to think that there's still a very little economic reasoning, so economic argument that could be made of business case analysis for a cross-border activity at this point in the union. So I think that for me, if I were to pick something, I would say let's work on completing the banking union, mainly on the part, as I said, of the deposit insurance to make sure that we have that effective single market, but also on the part of a more clear and effective recovery and resolution strategy. There are other areas, within the capital market union that I'm sure will be picked up by other bodies that I can talk about. We need to beef up the securitization industry as well, for sure. That will be a very important aspect, I think, for the banking sector as we give them tools to manage the large amount of NPLs that I think will be coming into their balance sheets. Securitizations is obviously a very logical strategy for them to pursue, and we know that all the work has been done there. Again, and the evidence suggests that there's still a lot that could be done. But you asked for one, so I'll say complete the banking union. Thank you.
Thanks very much, José Manuel. Gabriel?
Yes, it's as José Manuel said, it's to choose the pan-European personal pension product that the PEP that we have been developing along these years, that we delivered the final steps from our side in August to the Commission. This is something now that is going to be put legislation, and hopefully from next year on will be, I think, very important, because as a capital market union can, of course, translate also important results to the citizens, and this is an area specifically where, instead of saying, how can we as citizens support capital markets, it's the contrary. How can capital markets support citizens and support having better pensions for the future? Because pensions adequacy is a fundamental issue throughout Europe. So the PEP, the way that we build it up, I really believe it is transformational. I really believe it is really a paradigm shift in terms of simplicity, standardization. We have to avoid fragmentation throughout Europe, so that you can do cross-border. It's a pan-European product. In terms of transparency, with a completely different way of looking at the information that is given to consumers, completely digital, because it's already the information documents are thought to be on a screen of a smartphone, so completely digital in that sense, but also cost effective in the sense that there's a limit to the costs that you can impose on the savers on a yearly basis. And this will force, for sure, also to change somehow the way that distribution works throughout Europe in this type of products. We need to have distribution putting the costs down, and also in here, digital is going to be quite an important element. So we have all the bases there. What we need, of course, is that competition works. So this product can be sold by life insurers, can be sold by asset managers, funds, can be sold by banks, can be sold by pension funds. So competition is there. We need, of course, the providers to start to put products, but also we need appropriate tax treatment to this, so that at least that these PEP products are not have not a worse treatment than the current national products for retirement savings. And we need also consumers, to push for these products and to make sure that they are very clearly focused on getting a better outcome for their retirement. And if that happens, let's be honest, supply will follow the demand. So I really believe that the PEP can be, as we have the UCITS trademark on the asset management side, I think that the PEP can be the trademark on the pension side throughout Europe.
Thanks very much, Gabriel. Stephen?
Pedro, maybe before going to this issue of what should we do further at European level, just to reflect briefly on your conclusion of what is important, of course, in the recovery and going forward is to maintain those parts of the economy that are, let's say, healthy and that are productive. And you to some extent, you want to bridge the time, make a bridge to better times. Where the real problem is that it is very difficult to judge at this stage which parts of the economy are healthy and which parts not, because it's very difficult to judge how, even if the pandemic is behind us, how it will have changed consumer preferences. And it is very likely, of course, is that the healthcare industry, is that technology will not only during this time, but probably also after the pandemic, be in a better shape and should be, more demand for these type of activities. And in all likelihood, it will continue to be difficult, even if the pandemic is behind us. For example, tourism, leisure, and travel. And so there are also questions around if we fund and finance too long unproductive parts or likely unproductive parts of our economy, that in itself is, of course, will be a loss to our society. So there's also issues around not maintaining all capacity that we currently have is not necessarily the right thing, because it is in all likelihood our economies after the pandemic will look structurally different than the ones before the pandemic. Then going to the what kind of action should we do at a European level? What can avoid fragmentation? I only want to underline again, and very much aligned with what Gabriel said on the importance of retail participation, pension funds. It is really, and we need to. I'm very happy that also the Commission action points includes the retail participation and the pension side, but we need to monitor this. We need to emphasize this, because I think that is really very important to get the capital markets union going. On the supervisory side, interestingly, we don't talk about completing the CMU. We always talk about completing the banking union, but we don't talk about completing the capital markets union. And to some extent, I also see it more as a continuum, where in the past 10 years, we have had more stronger powers in the area of supervisory convergence, and also stronger role at the European level for direct supervision. And so, considering the nature of capital markets, there will always be, or at least for a long time, there will be this combination of national supervision combined with the European supervision. It also has to do with the fact that we're talking about thousands of investment firms, thousands of investment funds, and so having a completely centralized model is not easy to see as the end model in this area. But what I really would like indeed is to continue along this dimension, stronger convergence powers, more direct supervision at European level. That has been the situation, the direction of travel in the past 10 years. And it's important that we continue there. And to make it more concrete, I would hope that in terms of direct supervision at European level, the next stage would be getting European CCPs under supervision at European level. It is very asymmetric that third country CCPs are now under European supervision, but not the European CCPs themselves. And I would hope that we can close that gap in the years ahead. On the convergence powers, in all fairness, I want to thank the co-legislators for the improvements that we have received this year. I'm happy about the improvements, for example, around the peer review. We have seen that it's an improvement. But next steps there, I think, is looking and getting inspiration from, for example, the convergence that is applied to smaller banks by the SSM. And so smaller banks are not, as you know, and working at the SSM, you know that very well, is that the smaller banks are not under the direct supervision of the SSM, but you have a very strong convergence model for the smaller banks. And I think that should also be a source of inspiration for further strong convergence, I would say, at least for ESMA. And possibly also José Manuel model.
No, that was exactly my take. I mean, since you are touching on an issue that also I wanted to raise, I would ask José Manuel and Gabriel to comment on your last part regarding the convergence of powers and indeed more integration of supervision. I remember that Gabriel mentioned it recently in the European Parliament, maybe Manuel, and also taking advantage of having one chair that is in a way more in the beginning of his mandate and two chairs that are more towards the end of their mandates. So to be also good to see what is your perspective on the future of the European supervisory authorities. So maybe Gabriel, if you want to comment first, and then Jose Manuel on this last point by Stephen.
Yeah, no, definitely, and I totally agree with what Stephen was mentioning. I think that's the right approach. Of course, there are different realities in different sectors, and the number of companies, the intensity of cross-border business. But when you look at insurance, for example, around 65% of the business in insurance is done by the big European firms on a cross-border basis, either to subsidiaries or with branches. So this is clearly a business that is quite integrated, and we need to have more convergence on the supervision. I think that there's ways of doing this in a step-by-step format. I also believe, as Stephen was mentioning, that these models that we have seen also in the SSM in relation to the small banks make a lot of sense. We need to have much more common tools in terms of supervision also, and there's a challenge which I think it is also to look not only at the prudential capital solvency supervision, but also on the conduct of business supervision. And in conduct of business supervision, believe me, we have been doing a lot in that area in terms of assessing what are the supervisory practices throughout Europe. And if the differences are there on the prudential side, on the conduct side, it's even bigger. So that, I think, it's a huge challenge, and especially if you put it in the context of European products. It doesn't make any sense to have a product like, for example, I mentioned the Pan-European Personal Pension, which is a standardized European product, and then to have supervision completely decentralized at the national level, not even in terms of registration to be centralized. So this is something which I think step by step we need to build. But I'm confident, and I think that that old saying of never waste a good crisis, I think that will come also here, and I'm positive about the future in that area also.
Thank you, Gabriel. Jose Manuel.
Yeah, thank you. I mean, I think that here the banking sector obviously has a deeper experience of having integrated and coordinated supervision, not for the whole EU, but at least for the banking union. And I think that it's fair to say it's for others to judge, since we're probably part of this process, particularly you, Pedro, and I. But overall, I would say that the experience so far has been at least positive, and I think it's clearly in the right direction. As we go forward, I think that will continue, and I mentioned before that we need to complete the banking union and enhance the ability to make the single market more effective. But I want to pick up on two other points, one that Gabriel mentioned for further supervision. One is financial crime. AML, this is an area in which, we have assumed, we used to have limited share responsibilities that frees us together. We as the EBA have assumed this responsibility at the beginning of the year. The assessment clearly is that there's huge amounts of diversity in AML supervision across the union on effectiveness, and this is a situation in which you're as strong as a union as your weakest link. And I think that that's an area I'm happy to hear and to see that the Commission has picked that on board. It seems that the Council is also, and the Parliament, they have at least a principal agreement that they need to work on this area and move forward. I really look forward for that. We have contributed with a call for advice, with technical advice to the Commission on this issue, and I hope that will go forward. The second aspect, which I think is also important, is perimeter of activities, with financial innovation and technology. I think that's very important. We also, the ESAs have also sent some advice to the Commission in the past about areas of the regulatory framework where there were gaps, particularly on crypto assets and things of that sort, but this more broadly, it's an area in which work needs to be done. The Commission has put forward the digital finance with two specific proposals on digital operational resilience, which is one area for banks particularly, but I think for all financial sector where we have concerns, because there's been a lot of subcontracting of some of that digital operational activity to third parties, and the ability to supervise what's going on with those third parties is crucial. And we need to make sure that we have a good handle on the whole value of the operations of the financial sector, for instance, the financial sector. But also, as we continue to go forward, obviously the way that the business and the services are provided to customers is changing with technology, and as a result of that, also the providers. And we need to make sure that we complement what we now have a strong, entity-based supervision, to also very strong activity-based supervision if we think that that activity should be supervised, and make sure that it's properly supervised to ensure level playing field across sectors, but also cross-country, and that's an effective single market. So I think those two areas in which I see that convergence will be very much needed going forward.
Well, thank you very much, José Manuel. I think we are now close to the end. We have now 2 minutes. So maybe I would conclude the debate now, but let me tell you, I think it was fascinating. I learned a lot, even though I'm in the business as well. I think you provided a fantastic overview of what is going on and what are the challenges coming in the future. Maybe my main takeaway is that if we don't have more European integration in the financial system, it's clear that this will not support the recovery and the transition then to a new equilibrium, like Gabriel was saying. And this is serious and it's critical, because otherwise we have the risk that indeed this pandemic will increase also the differentiation between member states, that we have again member states being left behind and some moving faster and transitioning faster than others. And this is what puts then European integration again at risk. And so this is why your role is crucial in this regard. So thank you very much. It was a great pleasure, and at least made me forget the pandemic for almost an hour. So thank you again, and I'm looking forward really to see you physically as soon as possible. So thank you.
Thank you very much, Pedro. Bye-bye. Thank you very much.
Thank you, Pedro. Thank you, Luis.
Thank you very much.
Bye-bye.
With my full commitment to Lisbon next year.
Thank you. We hope so.
Bye-bye.
Thank you.
Bye-bye. Thanks a lot, Pedro.
Bye-bye.
We are moving on then to the next session with a presentation by the Vice Governor of Banco de Portugal, Luís Máximo dos Santos, whom I thank heartily for being available for this presentation. And out of coincidence, I think that Gabriel Bernardino has prepared the ground for us. I can assure the audience this is not a Portuguese cartel, but Gabriel Bernardino has prepared the ground when he mentioned the importance of conduct of business supervision, which is precisely one of the key points that the Vice Governor Luís Máximo Santos will, I believe, address. But I will give him the floor, thanking him again for his presence and also for the continuous support of the bank. Thank you.
Thank you very much. Good afternoon, ladies and gentlemen. Let me begin by thanking you for inviting me to the Annual Conference of Research Center on Regulation and Supervision of the Financial Sector. I would like to greet and congratulate Professor Luís Moraes and all those who have helped make this conference possible for their determination in preventing this event from being taken from us in this dramatic pandemic year. I would also like to take this opportunity to greet all the other speakers and attendees. It's an honor to me to participate in this conference. The COVID-19 pandemic and the measures adopted to tackle it have had a huge impact on all economic and social sectors, and therefore on the banking and financial business in general. A new environment has emerged, affecting the performance of all economic agents, households, enterprises, and the state. Until when? We do not know yet. It should be stressed that this time, after some initial hesitations, mainly from political agents, the response of public authorities has been strongly convergent and coordinated, both at European and national levels, using all possible tools. Monetary policy with, once again, ECB's prompt and resolute action, fiscal policy with the suspension of the European fiscal rules in force and the adoption of an unprecedented stimulus package, regulatory and supervisory policy at its various levels, macro and microprudential and banking conduct, involving several measures to his regulatory requirements. The magnitude of the crisis, its abrupt and global nature, combining a supply and demand shock, did not leave much room for the various public authorities to act differently. This crisis causes indeed asymmetric effects, but it is still more symmetrical and profound than the global financial crisis, which has allowed for greater consensus and speed in responses to be adopted. What happened during the financial crisis was therefore not repeated, and these are good news. It is now far from clear what the profile of economic recovery will be. The answer to that question will definitely shape our future and what will happen to the banking system, and will shed light on the real scale of the problems we will have to face, which even in the most optimistic scenarios, in my opinion, will always be of great magnitude. I will focus on the extra challenges brought by the pandemic to banking conduct supervision and its importance in ensuring confidence in the banking system, thereby contributing to financial stability. As a matter of fact, this crisis has proven to be an opportunity, needless to say unwanted, to show that the aims of prudential and conduct supervision, rather than conflicting, converge in the ultimate purpose of strengthening the banking system. In fact, the stability of institutions will not be achieved without their customers being provided, under the general regulatory framework, with adequate and reasonable solutions to their problems. The pandemic has boosted the use of digital channels by consumers of banking products at all levels. This trend was long underway, but due to the particular circumstances surrounding the pandemic, it gained momentum. This boost represents a further challenge for banking conduct supervisors. Against this backdrop, it should be noted that in June this year, as a result of guidelines of the European Banking Authority and its own experience in supervising the marketing of financial products and services via digital channels, the Bank of Portugal established a set of best practices to be complied with by banks when marketing banking products and services through digital channels. On the other hand, right at the onset of the pandemic, the Bank of Portugal adopted several regulatory measures concerning banking conduct supervision in accordance with the circumstances created by the pandemic, in particular, the easing of specific regulatory provisions, recommendation to institutions on the need to adequately comply with guidelines of the European Banking Authority on public and private moratoria on loan repayments, regulations on the duties of institutions to disclose information to bank customers in respect of moratoria, definition of information content to be reported by institutions to the Bank of Portugal regarding the use of moratoria. The current framework is very demanding for banking conduct supervisors as a whole. The pandemic environment is a threat to the solvency of many customers due to loss of income and rising unemployment. Litigation with institutions will tend to rise, and therefore complaints to the supervisor as well. Financial education, one of Bank of Portugal structuring pillars in the banking conduct field, will have to be reviewed and adjusted to conditions compatible with the pandemic, which in fact is already happening since the beginning of the second half of this year. On the other hand, the technological revolution also involves a revolution in the way supervision is conducted and is thus a complex challenge for efficient and effective regulation. The so-called RegTech is a road of no return, but it is still in its infancy. But the use of digital technologies has no magical or saving virtues, nor does it solve problems by itself. A faster rate of innovation leads to also faster obsolescence, and therefore innovation cycles and gains generated are shorter, which is also a problem to the banking system. The digital transformation process underway was enchanting, almost magical effects when we listened to certain speakers. But knowing, in the deepest sense of the word, is much more than using technology. Knowledge does not come solely from the technological process. It is actually interesting to note how extraordinary technological developments are coinciding at a time when, paradoxically, purported pre-enlightenment concepts and visions are gaining ground in society. Therefore, the permanent revolution of our way of life forces us not to lose sight on the fact that human behavior is undoubtedly at its roots. In an age of large-scale dissemination of technology, it is the human factor that will tend to make the difference and lay the foundations for lasting economic success. The soundness of institutions must be built on ethics put in place rather than on proclaimed ethics. For reasons we all know well, this is even truer as far as the banking sector is concerned. The year 2020 has already marked our lives. Suddenly, the whole world was faced with a pandemic that undermines the foundations of our life in society. From incredulity, we quickly moved on the deepest fear. The fragility of our condition has emerged with startling and overwhelming evidence in the hyper-technological society of our time. The Homo Deus, to use the concept of Israeli author Yuval Harari, was faced with an unexpected throwback to a very distant past, which we knew was possible, but which we actually imagined only as abstraction. Driven by survival instincts, societies and countries have reacted, though not in exactly the same way, nor at a synchronized pace, by adopting measures that would have been unthinkable a moment ago. At the Bank of Portugal, we are united to get through this hard test, and we will do everything we can to meet the demands we are faced with in our mission, thus building confidence in the Portuguese banking sector and in its customers. Thank you very much for your attention. And once again, thank you very much for the invitation.
Thank you very much, Luís Máximo Santos, Vice Governor of the Bank of Portugal. I think it was a very enlightening perspective, going not only to issues pertaining to market conduct supervision, but also to the fundamental problems of the culture of the financial sector, which is something which should also be discussed in these times. Thanks a lot, and we hope to have you with us again in a physical format next year. Thanks a lot.
I hope so. We can see in Lisbon in the normal, say, like this conference.
Definitely, it's our expectation. Thanks a lot. Thanks a lot.
Okay. Thank you.
We shall then initiate our last panel of the conference without further ado, which is a panel with a broad title, but which somehow summarizes also the key concerns that are underlying our conference this year. The title is Economic Recovery and Financial Stability. The panelists, of course, need no introduction, so I will be very, very short in the interest of time. We have with us Ana Paula Serra, board member of Banco de Portugal in charge of Prudential Banking Supervision. Welcome and thank you for being with us. And we have with us also Mario Nava. Of course, when I invited Mario, I was counting with a physical meeting in Lisbon. Unfortunately, the circumstances have evolved. There's an invitation which dates January this year, but unfortunately, everything has turned out differently, but you are with us digitally as a second best. Mario is at the European Commission. He's Director General of Structural Reform Support. He was previously at FISMA, so he has sort of a dual hat which can enlighten lots of aspects in our discussion. I would ask each of you, perhaps starting with Ana Paula Serra and then moving to Mario, a short initial statement. I understand that your focus might be, or your starting point might be slightly different, with Ana Paula Serra possibly focusing on supervisory strategies for banks in the context of the pandemics and also on issues pertaining to the completion of the banking union, and with Mario possibly focusing on key elements and inputs from the European Union that may impact on the economic recovery and on the basis, of course, in turn also in financial stability. Also possibly with some words concerning potential developments in the capital markets union. But I would not add for now further considerations. I will give the floor, thanking her again for her presence with us, to Ana Paula Serra.
Thank you very much. Can you hear me well?
Yes, perfectly.
Okay, thank you. So good afternoon to all of you, and let me start by thanking Luís Moraes for the invitation to participate in this conference. It's a great pleasure to participate in this panel together with Mario Nava. Of course, given that we are the last to speak, and there are some messages that have already been conveyed, but anyhow, some we will stress when there is, I'll say, particularly with the last panel that was very, very interesting, a lot of messages that are common and that we are convergent. So, of course, I will focus more on what supervisory measures we observed in recent time, and of course, with a forward-looking approach. So, as the full impact, so the Mario Centeno in the morning mentioned, of course, our government, the full impact and the consequences of this pandemic crisis on the real economy and on the banking sector are still very uncertain. Of course, many also have stressed that we know that this crisis is different from the previous crisis, And the great financial crisis, the crisis that we lived in Portugal, because now the origin of the crisis is external and affects all the world. External, the Western, the Eastern, the developing, the developed countries, we are all being affected simultaneously by this pandemic, and of course the crisis that is the consequence of that pandemic. In the particular case of the euro area, the bank's starting point, as we all know, in terms of capital and liquidity ratios, was much better, and by the end of 2019, the CET1 ratio stood at close to 15%. The leverage ratio was 5.6%, and liquidity ratios were very comfortable compared to recent times, let's put it like that. So banks were indeed better equipped and prepared to deal with the crisis, and the banking sectors were such that it was possible to withstand the immediate shock and also hopefully face the downturn that will come much more easily than in the past. So far, I think we all agree, the banking sector has acted and will continue to act as a stabilizer, enabling economic recovery. Of course, the banking sector has also benefited a lot from what governments, central banks, supervisors and regulators did to manage the COVID-19 crisis. So several important measures were implemented, and these had a direct or an indirect impact in the banking sector. And of course, as also many have mentioned, as José Manuel Campa just mentioned, the timing of the adoption of this measure was also key to sustain markets and banks. We all know that, first of all, payment moratoria to households, mortgage and personal loans, and also to non-financial companies, giving time to individuals and companies to recover. So we have postponements that vary between 6 to 18 months, and this can be, and we do believe that giving time to the companies and individuals will help to overcome the crisis. And European Banking Association guidelines granted a lot of flexibility to banks on the application of the prudential framework regarding default, forbearance on these payment holidays. And banks also benefited a lot from the flexibility in IFRS 9 application with a forward-looking judgment of distress in order to avoid excessive procyclicality. These measures were really important, but of course ECB and the Euro area NCA allowed also banks a lot of flexibility in the use of capital buffers, and also issued recommendations to retain internal capital by suspending the distribution of dividends for the financial years of 2019 and 2020. Regulators helped with the CIR quick fix, providing banks with the relevant RWA reduction and further capital releases and extra flexibility. So all these measures have strengthened banks' capital positions to provide support to the real economy and absorb losses. But this was also possible thanks to the public guarantee schemes given to micro, small and medium companies. And last but not least, the very accommodative monetary policy measures. Let me stress in particular the role of TLTRO3 and the collateral framework easing measures. These were critical to assure banks building up of liquidity buffers, and that we have seen that at least partially have been used to grant loans and to deal with the moratoria. So unlike previous crises, there was no tightening of credit, and of course all these measures together allowed that. national and European policy measures have played and are still playing a very important role in containing the impact of the crisis, and we don't know the outlook for the European economies remains still very uncertain, and the impact of lockdown measures were only anticipated in adverse scenarios, not baseline scenarios. Yet, and I think the governor said that in the morning too, if the pace of recovery is similar to what we witnessed over the summer, if we are able to fight the pandemic in an effective way by early 2021, the negative effects of the crisis may somehow be contained. Hopefully this is not only on my side wishful thinking, because what we've seen over the summer seems to suggest that if we keep, and as others have said, if we keep the potential on the economic side of companies, it could be the case that they recover very fast. So, of course, this is what we have seen so far, and as you know, supervisors since then are very carefully thinking about the unwinding of moratoria and other flexibility measures. So we as supervisors have to make sure that we don't unwind the relevant measures too early or too fast. And we also have to be very careful to avoid lack of coordination that will diminish the effect of measures that are still being implemented by other authorities. And on this side, ECB, and of course I'm mentioning ECB, but other NCAs such as Banco de Portugal have already communicated the build-up of capital buffers needs to start only by the end of 2022. So while we recognize the need to act prudently, we want to contribute to a soft landing. But the main concern is that banks are properly preparing to deal with the expected deterioration in the quality of their assets, and this is going to occur. And of course, and then let me turn a little bit about how all this setting fits in the regulatory and institutional architecture where we are included. And the first balance, of course, is that the institutional reforms carried out in the EU in recent years were important to, as I mentioned, to make sure that there was this timely response. And let me stress in particular how the good coordination at the supervisory level between the ECB and NCAs, enabling that the measures were applied not only to significant institutions but also to less significant institutions. So I think this shows that the institutional reform that we have on the side of supervision, of course, helps a lot, but of course there is still a lot to do in terms of the construction of the banking union, and we know that what has been envisioned in 2012 is not yet completed. So the first pillar that I just mentioned, the SSM, is completed, and that after 6 years is now in a much more mature phase. The second pillar is also ongoing and advancing at a fast pace, but there are some difficulties here. While theoretically it applies to all banks, in practice it has shown that smaller banks have some difficulty to assess these resolution solutions. So not all institutions meet the requirements to benefit from the regime and access the mutualized funds of the Single Resolution Fund. So this means that they are left with one option, liquidation, and even this is the case even when they are systemic relevant at a regional or national level, with the resulting consequences in terms of financial stability. As for the third pillar of the banking union, the common deposit insurance scheme, this has not been implemented and there has been no agreement, as you know, on a fully fledged EDIS, and debate has turned to alternatives that could somehow solve the inconsistencies and the difficulties that arise from an incomplete banking union. And in the current context of COVID-19, when we turn to a crisis mode, of course, the difficulties are amplified and call for a careful but urgent policy reflection on whether the existing crisis framework is sufficient to properly deal with bank failures in a systemic scenario. So I would say it is important to revisit the resolution regime and also to reconsider precautionary recapitalization rules. So the resolution framework could be well complemented by alternative financing mechanisms, increasing banking sector resilience and cost efficiency. Another important related topic that has to do with the role of preventive measures in the crisis management framework. In particular, we have seen some recent experience in some euro area countries that suggest that DGS could also be used to prevent the failure of banks, and maybe these complements could translate into lower costs of intervention as compared to a single action payout. Another related and very important topic that is very dear to host countries supervisors is exactly the balance between home and host countries. While banking market integration, of course, and we mentioned that, the previous panel mentioned that it should be pursued, there are benefits for citizens all over the euro area and in Europe. If that is true, this cannot be done at the expense of financial stability and DGS at the host level. So in the case of significant subsidiaries, waivers of capital and liquidity requirements cannot be granted since there are no sound effective safeguards of intergroup support. So while these conditions are not met, those countries' competent authorities rightfully they have the right to demand the application of prudential requirements at the host level. So these are only a few issues, among others, that I think need to be addressed in a future updated framework. But I feel that step by step we are progressing, and I trust that in time we will bring the banking union to a closure. The sooner the better. Let me stop here. Thank you for your attention.
Many thanks, Ana Paula Serra, and I beg to contradict you because you have not overlapped but introduced important new points beside the ones we have already discussed. But I would now give, without further ado, the floor to Mario. We have conspired a lot to have you in several times here in Lisbon. Finally, it's happening, but not in the ideal scenario. The floor is yours.
Yeah, caro Luis y cara Ana, boa tarde a todos. Y a todos, a todas y a todos. It's a great honor to be here with you today. It's also a great regret not to be there physically, but to do it in this way. Still, I think the quality of the debate makes it up for the lack of the physical presence, as the Vice Governor was just saying. I'm particularly pleased to be able to speak at your research center, Luis, because your research center is one of the Jean Monnet chairs program. And if you allow me, I would start exactly from Jean Monnet, which I think, even if he did not know it, he saw most of the banking crisis. Jean Monnet said famously, people only accept change when they are faced with necessity, and people recognize necessity when a crisis is upon them. This is exactly what has happened during the banking crisis and the formation of the banking union. Imagine, Luis, if 10 years ago, let's say in 2010, you would have invited me to your research center, and I would have exposed the following theory, that the national supervision of the biggest bank to the European Central Bank. I would have probably been laughed out of the room, easily. I mean, we probably would have been kind, you would have invited me maybe to the dinner, but today I would have been laughed out of the room. And then now, this is what we did during the famous summer of 2012. I mean, as we all know, the Council called for the banking union in June. The Commission presented something at the ECOFIN, the informal ECOFIN of Cyprus in September. And then the Council had the first decision in December. In 6 months, as Jean Monnet said, necessity, crisis, upon them, decision. This is exactly what has happened. Now, this is not very dissimilar from what we are observing now. Also, in many things, I mean, I've been, as many of us, I believe, I've been thinking a lot of the similarities between the banking crisis and the, let's say, the medical crisis. No, if you think at the very beginning, it started in a similar way. We all look at each other with a bit of suspicious. So at the beginning, the obvious problem were the Italian banks. Why not? Or the Spanish banks. It took us a while to understand that it was actually a structural issue. Very much here has been a little bit like that at the very beginning. At the very beginning was this region or that region that was obviously more infected, and therefore we need to look at that. And then, only then, we understood that that was actually a structural issue, calling for a structural change, as I think Anna Paula has said very well that that we needed to address. In the division of work with Anna Paula spoke about financial supervision. Financial supervision deals with how money are borrowed, moved, or lent around. And I was given the task to speak about something which has come more and more prominent in the last few years, which is how money are spent about, on what should we spend money. Already in these, you see a bit of a change in the culture of the Commission. We used to be mostly a regulatory body. Brussels used to make rules. We used to spend money in a shared management way, so through the cohesion funds or the structural funds, which are well known. But it's only with the Juncker plan that we moved to what I like to call a decentralized demand policy, and I'll detail why I call it a decentralized demand policy in a moment. But I think it's important to understand this move from only regulatory issues, so basically only the supply side, to say, okay, here we have an issue of an investment gap. Essentially, we walk our way out of the recession if we close the investment gap. And how do you close the investment gap? You close it with more investment, for sure, but also with reforms. I mean, you could do some spending in the short run. It does well, but it's exactly like to take a painkiller in front of a coronavirus. The coronavirus, we all know, it's very nasty and it pains. So you take a painkiller, you have some sort of relief. There is no doubt. Problem is that it's limited. What we all want for the coronavirus is to have a vaccine. So that is exactly the same thing. What we are looking for are reforms so that our investment becomes sustainable in the long run, and is exactly like equivalent to have a vaccine. So, and again, very much like in the banking union, necessity and crisis upon us, we acted. The same thing here. Only that here I'd have to say we acted even fast. It took us years to devise to be ready to the idea of the banking union. Here it went much faster. My president said once famously in the European Parliament, it took us 4 weeks to do what in other circumstances would have taken 4 years. So in 4 weeks, and again, I'm speaking only about the spending side. Anna Paula, I think, has been extremely detailed and very good on the regulatory side. So on the spending side, what have we done? Well, the SURE program, of course, that is I think the very first instrument we made to exactly allow economy to go on, to avoid that a temporary gap in demand and the temporary block of the supply would turn permanent. That's clearly has worked pretty well. But then, of course, the big thing has been the agreement on the multi-annual financial framework and on the next generation EU. That agreement has allowed, as you know, the agreement is also very recent, not only the agreement in the Council, but also between the co-legislators, which dates of a couple of days, has allowed to continue this sort of what I call decentralized demand policy. In which sense decentralized? Because basically with this instrument we empowered member states to set up a recovery plan. So they're empowered to have this recovery plan for themselves. In this sense is decentralized, and is also decentralized because we are testing with the market, by going on the market to borrow resources, what the market thinks about the overall plan we have put forward. Till now, for example, the first issuance of the social bond was, I dare to say, quite successful. I mean, we issued the first social bonds, and the reply of the market has been quite solid. Not something that economists did not say for years. I mean, in my previous job, you kindly reminded, Luis, often I went to Asia, and I often was confronted with questions from the Asian investors saying, if I want to invest in Europe, can I buy this country or the other country? But where are the European bonds? Well, here they are. So now there is something which, of course, makes the market incidentally. In the green area, as you know, when we will issue green bonds, we will do the market, because we will basically design the whole yield curve from 0 to 30 years. So we'll do the market, and that, I think, is clearly a main advantage. So that's what we have tried to do. But as I said, of course, this is great. But what we need to understand, and again, my president said it very clearly, is that we cannot remain with the status quo. We need to change, to reform in many areas. Not for nothing, the president created this DG reform on the 1st of January, exactly to help. The legislative text says, help member states' administration to design, develop, and implement reforms. That's what DG reform does. Help member states' administration to design, develop, and implement reforms. Help them to apply EU law. Help them to use EU funds. So we basically can act as an accelerator for the reforms. But it's fundamental to understand one thing, that in order for our help, our technical support to be successful, what we really need is that the reform mood, the reform awareness is deep in member states. We can help member states to design and develop and implement reforms if member states are committed to reform. And this is really a crucial point, the reform commitment of member states. We as DG Reform, we act in 5 very broad areas. They go from governance and public administration to the financial sector. I have no time to detail all of them, but let's maybe give you a couple of examples. One very clearly is the area of governance and public administration. We saw it very clearly during the crisis that the countries and the regions with an efficient public administration were much better able to respond to this crisis. There is a very recent study by André Sapir at Bruegel, and it shows that between 35 and 45% of the GDP losses during these crises can be linked back to the quality of the public administration in the place where the COVID struck. So this is really a big result. As I said, is a very recent study which which is becoming quite famous, but it shows very well that the quality of public administration matters both in the positive moment when you need to plan, when you need to design, when you need to have a vision, and in the negative moment when you need resilience. That's why our plan is called recovery and resilience. The two things are quite essential: the recovery and the resilience, and a greater public administration, a digital public administration, and a public administration which is able to talk among the different levels of governments is, of course, essential in the moment where we are trying to close the investment gap. Because that's what it is in the future. In the next few years, you have seen the European Union forecast. We do have a gap to close. Anna Paula was very right to say there are some upside risks. I mean, we could find a vaccine, hopefully sooner than later. We could be able to deploy all of that. So maybe we are able by 2022 to recover. But this means one simple thing, that from now till 2022, we need to be able to spend those money and spend them in a way which is sustainable, in a way that pays back for the next many years, because much of these will need to be paid back in a way from 2028 till 2058. So we'll need something which is truly sustainable, something which is long-sighted, and that, I think, is the essential point. And then the other area, the area of the financial sector. This is an area where, with my DG, we worked really a lot with Portugal. I mean, very recently, we have done, together with the OECD, a project for the Portuguese Capital Market Commission, which was actually presented at a high-level conference by my commissioner, by Elisa Ferreira, there in Lisbon. And the project supported the efforts of the Portuguese government to relaunch the economy by addressing capitalization of companies and recovery of investment. We selected 5 areas, and those 5 areas are very similar to what you see in the Capital Markets Union Action Plan that the Commission has published a few weeks or a couple of months ago, which follows from the Capital Markets Union High-Level Forum, where which I had the honor to lead, and where Maria Luisa Albuquerque was one of the co-chair, and in particular she was the co-chair of the retail angle, which is absolutely essential for the financial markets. So I believe that if we want to come out of the crisis, we need, of course, to continue this journey, having understood that this journey, it's impulsed by the crisis, but then it's up to us, it's up to the good governance to pursue it and to continue it also when hopefully the crisis has faded away. So that is what I wanted to pose as a first question, Luis, and very happy to take any other question coming. Thank you.
Many thanks, Mario. It was worth waiting to have you with us in this year's conference. Also a very positive message in terms of what we can expect from the European Union. I would perhaps reverse the order of the presentations, and in terms of questions and initiating the debate, would perhaps start with you, Mario. And you mentioned what is, for me, if I can make this personal comment, is a most interesting development in terms of the European Union, which is the SURE mechanism. So the decision which was adopted by the Commission, I think in April, which allows the provision of urgent financial assistance to member states in dealing with the emergency labor market related expenditures. I think that the SURE mechanism is very innovative in certain points. And if the question is not too specific, I think that some commentators have argued that the SURE mechanism could in time evolve towards a permanent European unemployment benefit scheme. And I would venture to ask what your views would be on that.
Well, I mean, let's say, first of all, it's very good to understand, and you said it very clearly, what the idea of the SURE mechanism was. Remember, we were in April, the world was in shock, incredulity said Vice Governor Dos Santos. So the world was in shock. We need to act it fast. So I think was honestly a clever decision to decide to act on the back of what we had. What we had were different systems in different member states, which shared a similar view. We had the Kurzarbeit in Germany, the Cassa Integrazione in Italy, Chômage partiel in France. And the idea was simply to support them, give support to them. Now, you say, okay, this has worked, no doubt. This has worked in the short run. This has actually, once again, and apologies for the publicity. If you look at the EU economic forecast, you see that there is a very big difference between the fall in the GDP and the fall in employment, and that's clearly something of which we should, I believe, be proud, because this means that we have the seeds to restart. Then what you pose I believe, a long-run question, but okay, let's look at the long-run question. It's not the first time that the idea was posed. I mean, few commentators have said that the more the economies get integrated, and therefore that there can be synergies, these could make sense. Of course, the next generation EU, people have said, is the Hamiltonian moment if you look at the financing side, or is the Marshall moment if you look at the expenditure side. Now, if it is the Marshall moment and you look at the expenditure side, clearly that means you will probably have more demand in Europe, more internal demand. Do you remember how many times you, me, and many economists, we said one of the problems of Europe is that we don't have enough internal demand. We depend on export. Okay, here it is, the internal demand. So I think there is at some point a virtue also in thinking of other mechanisms to protect the internal demand. But I repeat, I think in April, where we were, that was the right decision to take. Thank you.
Thank you. Thanks a lot. I would like now to move to a slightly different field, but perhaps I would put a question based on, I'm reviewing my notes, based on a consideration or a point made by Ana Serra, but I would perhaps, addressing the question to her, also ask Mario to some reaction. In the intervention of Ana Serra, you mentioned that possibly at the current juncture, and I'm translating freely or referring freely some of your considerations, that the supervisory strategy could be moving into a new phase, and a phase in which it will be time for the banks to, I would say, to brace for the impact that will likely materialize as the system-wide moratoria are lifted. And my question would have to do precisely with this transition phase. Should we consider already all the basis for an exit strategy, or should we take a more cautious or a more gradual approach in terms of an exit strategy in terms of the moratoria which have been allowed to banks? Of course, that depends on the pace of economic recovery and how the supervisors assess the pace of economic recovery. And I would like also to have Mario's views on this larger issue of the pace of economic recovery. But basically, I would hand out this question to you, Ana Paula.
Thank you. Thank you. So as I mentioned, so we don't want to move too fast, too early, because we all know people mention these cliff effects that are coming, but we don't want to anticipate those cliff effects with being not too cautious when, and I think at SSM the approach is we are waiting to see how uncertainty is being resolved. So one characteristic of the, let's say, most supervision in recent years is it has to adapt. And so I think my first point is about that. I think we, as you mentioned, we need to see how things progress. Of course, our base scenario is that this second, as I mentioned, so that the vaccine comes in early 21, and there is a fast recovery. And if that is the case, and that's our base scenario, of course, now we are more and more concerned about if banks are well prepared of the increase in problems that they will have, because that's not a question. That there are no doubts about that there will be an increase in distressed assets, in the quality of assets. So we are kind of trying to balance here, like we want banks to prepare, do their homework, so that they do not leave all the problems to solve at the same time. That's the usual cliff effect that people mention. And so I think it's really, as you know, SSM starting in April, and it finalized the exercise in June, July. We did a vulnerability analysis, but this was a very top-down analysis, looking at the sectors that were more affected by the crisis, trying to understand what would be the effect on banks. But this was the first exercise, and so we now need to move on. And of course, this is the work of banks and also of auditors. Banks need to make sure that they can disentangle, and this is not an easy exercise. Now, it's very easy to say, not very easy to do, to try to disentangle which are the companies, which are the households that are viable, if we can say that with regard to an individual, but which one are viable, which one are not viable. And plan-based plan, funding and capital, build their funding and capital plans based on that. What we really do not want to happen is that, given that there are the most, particularly in Portugal, you know, their moratoria affect a huge part of non-financial company stock of loans and also households. And what we don't want to do is, like, banks simply do not prepare operationally. And in fact, sometimes, of course, we know that in Portugal, given that we had to deal with the not very the recent crisis, many banks are prepared for that because they have not dismantled all the structure that they had to deal with these non-performing loans. Maybe that's not the case in other jurisdictions, that's not the case here, but we need to make sure that we start preparing to see what's going on, because our last concern, and I think Mario also mentioned that, is that we have a good allocation of resources. We want resources to, and this is the good allocation of financial resources. And in the previous crisis, and people sometimes mention that there are companies, the Zambi firms, the Zambi companies, that deter the possibility that banks play their important role in the economy. So, with a brief answer to your question, is that supervisors are really their main strategy now is to look at credit risk and what banks are doing, and if auditors are also properly monitoring what banks are doing in terms of recognizing, of course, the issues, the fact that many loans are in distress, and if accounting reflects that.
Many thanks, Paula. I don't know if from the perspective of the pace of economic recovery in general, Mario wants to add any observation. But yeah, beside that, I would venture also to address you another question, also looking ahead and bearing in mind the positions by some commentators concerning a possible wider role of the European Investment Bank Group in the recovery effort. And I would like to know, if possible, some of your thoughts concerning that potential enlarged role of the European Investment Bank Group. Mario.
Yeah, well, let me take it exactly where Ana Paula stopped, to the concept of resource allocation, that, as we all know, is both a microeconomic concept, but a macroeconomic concept as well. And I think there it's really where our project and our ideas will be tested. I mean, if we get the resource allocation wrong, where wrong means we invest in things which in few years are not sustainable, or that in few years give us the risk of being locked in all technology and becoming stranded assets, that probably that would be one of the biggest risks. I do not think, fortunately, that this should happen, because one thing I've seen it, and again, with the group where Maria Luisa was with us, we have seen it very clearly. At the beginning, when the pandemic exploded, there has been a moment where people said, the pandemic has exploded and we are here discussing about capital markets union. Does it make sense? Shouldn't we talk about something else? And then immediately we realized and we said, oh my God, this makes ultimate sense, because what we will need to come out from the pandemic is exactly a very good market allocation that the capital markets union can give. Let me be brutal. I mean, many of us have kids who are millennial or there around, right? So my 3 kids are born around the 2000, and that means that they will go in pension between 2070 and 2075. Now, does anybody of the 119 participants to this conference thinks that they can derive a return for their pension from assets which are not sustainable? I mean, let's be serious. We need to get a return in 2065, in 2070. Investing. Does anybody in her or his right mind thinks that assets which are clearly not sustainable, or which are clearly not in line with where the world is going, would offer a return? So I think resource allocation will be essential. This crisis, in a way, if you want, it's helping us a little bit to align the SDG goals with the recovery goals. That was not the case of the banking crisis. Actually, after the banking crisis, the SDG goals were a little bit forgotten. Here is clear. Here, nature, I mean, the virus is nothing else than nature, adverse nature. And we saw what adverse nature can do to the economy. And of course, it's very clear that we need to look at that with a view to the future. That's why I think all the work that the Commission has done to essentially lead, I'm sorry to say, but the European Union is the leader of the world in all the area of sustainable finance, and in general on the SDG goals. It's something which is really aligned with next generation. This is done for people that today are not yet voting, or they are barely voting, that today are not yet working. But this is done to make sure that they will still be able to derive money out of that. And then you mentioned the EIB. The EIB is the EU bank. So, for example, in this area of aligning investment with sustainability, the EIB was a precursor of many, actually, even of many private institutions. I mean, the EIB has been the first one to say we stop financing the carbon, because that is clearly not sustainable, and because we will not pay pension in 2050, 2060, 2070 by financing carbon. So I believe that the wider role is a wider role, certainly of the EIB, but also of many of us. I mean, we will need to have investment which will take into account the several constraints and turn the constraints into opportunities for the foreseeable future. Thank you.
Many thanks, Mario. We have 2 minutes. If I could ask each of you for a very final concluding thought, bearing in mind financial stability, which has somehow represented the leitmotif of our conference, could I ask each of you a very final and brief concluding thought, starting with Ana Paula Serra and closing with Mario?
Thank you. So there are many important messages, but let me stress one that is much more related with the banking sector. And as we've seen in this crisis, it's important that we have financial stability and that banks can function to help crises and shocks. But of course, in this conference, we have been much more concentrated on the pandemic. And Mario has mentioned a lot about the future. And so if we think about the future of banks, we also need to think about the structural weaknesses that banks also present in Europe. And so while there were these were there before the crisis hit, and again, banks need to make huge investments to make sure that they improve their profitability, and all the digital changes, all the new players that compete with banks, and of course these are welcome if they also have benefits for customers and citizens. But we need to make sure that the financial system is sound, is resilient, and is part of this solution of to promote growth. For that, huge investments will be required in the future. And now I link this to the crisis, is that this is the time where those investments are needed. This is the time where banks are going to be hit by the non-performing loans, that some of them were not yet solved, and now they are even more to address. And at the same time, they need to make sure that they are able to meet these challenges of digitalization, and of course also to make sure that they face all these climate change challenges that all of us need to address. So in that sense, we as supervisors will continue to put pressure on banks so that they become more efficient. And I think the crisis was also, sometimes we say that the crisis was also an opportunity for banks to look at their structures, at their organizations, at what customers really need and demand. And this change will have to happen, and hopefully it will be also a smooth change that warrant financial stability all over the euro area and in Europe.
Many thanks. We are indeed closing the circle, returning to structural issues like profitability that we have discussed in the morning, particularly with Elena Carletti and Christos Gorsos. Many thanks. Mario, your final words?
Yeah, my final words, I think this crisis has shown us that economic recovery and financial stability are not static concepts. They are a dynamic concept. It's something that we need to ensure going forward, and it's something that changes. And if I may conclude with one sentence of one of the most fantastic writers of all times, Nobel Prize, José Saramago, a journey never ends. And I think that's the lessons that we need to take from the crisis. We are moving to a new normal. We are in a transition. A journey never ends. We need to make that transition possible. The transition will be long, but if we profit from that, we probably can get to a better place, because clearly the place where we were before was a place that needed to change, and what the crisis has been is a catalyst for a faster change. Thank you.
Many thanks, Mario. Many thanks, Ana Paula. I think I can speak for everyone, thanking you for a most interesting panel, closing our conference. And again, I state you the challenge of having you again with us next year. Thank you to both of us.
Thank you. Obrigado.
Thank you. Obrigado. Obrigado.
We will then move immediately to the closing session. We will have with us, representing our scientific partner of EBI, Thomas Stedner, who is the president of the supervisory board of EBI, and my good friend and colleague, Paulo Vaz Freire, who is the director of the law faculty at the University of Lisbon, and also José Miguel Almeida from the Securities Commission. And hopefully, I hope that either Ana Paula Serra or Luís Máximo can join us from the Bank of Portugal, just to very brief concluding remarks. But I would give now the floor to Thomas.
Thanks very much, Luis, for organizing this conference and also this great conference. You have been organizing this now for the 10th year running. You told me yesterday, and that's I think a fantastic success. And we are also very proud from the EBI, which I'm representing here, that we are able to be your scientific partner in this connection. So again, we do it for the 3rd year running together. I think it was a great success again, and thanks very much for organizing this, and also to your institute, CIRSF, for doing the heavy lifting in this regard. Also, a big thanks to all the speakers of this conference. I only was able to listen to the last panel, so I'm sorry, but a special thanks also to Ana Serra and Mario Nava, who have been speaking also at the EBI conferences at different occasions. Yeah, so the conference has covered a wide range of topics, and I think that's very important in these times. We have heard about this in this last panel very, very clearly, that there's a lot of change now happening, and I think for some of the points, the change is currently only developing. You don't know exactly what the turnout is going to be, but you already see some trends developing in this and that area. But it's also, I think, a very good occasion to check essentially some of the regulation which has been introduced after the last financial crisis on its usability, on whether it really makes sense in practice. Yeah, and in this regard, I think this conference was a very useful tool to discuss these topics. We had from the EBI last week our EBI policy conference, where we also had representatives from the Commission. Executive Vice President Dombrovskis was there, from the SRB, Elke König, from the Single Supervisory Mechanism, Mrs. Petrazelli and others were there. And these topics were also discussed in this regard. The development of the banking union, the capital markets union also is a consequence of this crisis, but also more specific topics, the bail-in tool, IFRS 9, whether all of this really proves to be working in a crisis mode, yeah, and whether some of the tools have been developed and they work maybe on an idiosyncratic basis, but are sometimes a bit difficult to apply if you have a systemic crisis like the one we're having right now. Buffer usability was another topic which was discussed, which is also a very important point. I mean, you see this also in connection with some of the measures introduced with the ECB, that some banks are really struggling to use all their buffers in this current environment, because that they are a little bit afraid that they're going to be tainted by the market as a consequence of this. So there are a lot of important topics, and I think it's very good that we have these conferences to discuss them and have a look what really makes sense, what doesn't make sense, and it's hopefully also some help to the policymakers in the Commission or in other institutions to adapt or reflect their own policy measures in this regard. If I just quickly turn also on the EBI in this regard, we are a very young organization. The EBI is now existing for the 4th year, 4 years now, but it's a joint venture of European universities, so reflecting really also this European spirit that you see in many different areas. I mean, banking regulation, capital market regulation is probably one of the areas where you see most integration. That's why the idea was also to essentially institutionalize the cooperation between European institutions in the European Banking Institute. And now, after starting with 7 universities, the EBI now has 33 universities as members, academic members, and the key work, obviously the key work is the academic work, and then here there's a working paper series, discussion paper series. The key point for us is also to be not only cross-border, but also to be interdisciplinary, covering law, the economics, and the accounting topics. And the key conference for us is the Global Annual Conference, which will take place next year, 11th and 12th of February, for the 5th year running. Unfortunately, I have to say also again, in an online format. I mean, it works well, but I still prefer conferences where you can meet and greet people and also have a drink afterwards, to be honest. But this is not working at the moment, but hopefully we'll come back to this time very soon again. If I talk about the academic work of the EBI, I also would like to mention the first ebook, which was published this year on pandemic crisis and financial stability. So a topic also very relevant in connection with today's conference. The second pillar, if I may just mention, this is also the policy work, and I mentioned already our policy conference last week. We are now having a regular policy series once per month where we discuss current topics of relevance in our policy area and policy sphere. And one thing I would like to mention here, because I assume there's also a strong Portuguese audience, and Portugal is taking the presidency of the rotating presidency of the EU on 1st of January. We will have a policy series with either the finance minister or a deputy finance minister of Portugal, where they explain specifically the areas relevant for banking and capital market regulation, which will be on the agenda of Portugal for the next 6 months after 1st of January. So this is something where we also would be happy to invite the participants of this conference. And then obviously the key part of our policy work is the policy conference, which took place last week. With this regard, Luis, again, I would like to thank you for organizing everything and also giving us the space to present the EBI a little bit. Thanks very much to everybody, to all the speakers, and to you again. And then I would hand back to you, Luis. Thanks so much.
Many thanks, Thomas. It is indeed a great pleasure, our intense cooperation in the last 3 years. I would flash the last point that you've mentioned, thinking about the near future, because we are indeed scheduling as a joint organization of CIRSF and EBI a policy seminar with either the Portuguese Minister of Finance or the Secretary of State of Finance to present the priorities of the Portugal presidency of the European Union concerning the financial sector. It will happen in January. We will announce it briefly, so stay tuned to that. And now, without further ado, I will give the floor to my good friend and colleague, Paulo Vaz Pereira.
Hello. Hello all. Thank you very much. It is a great pleasure for me to say a few words at the end of this conference. And on behalf of the Faculty of Law and of the University of Lisbon, I would like to state that I'm very grateful for the opportunity of once again being a partner of this event. But most of all, I would like to express my warmest thanks to my colleague and friend, Professor Luis Moraes, who is actually the driving force of this event. He inspires us with his enthusiasm, and he managed to bring together brilliant speakers expressing their opinions and ideas about current and inspiring themes. Well, today's conference was about the major trends of financial regulation. And, it's quite plain to see that financial stability settings make countries stronger and more resilient when crises knock on the door. On the other hand, in difficult situations like the pandemic crisis that is going on all over the world, the typical recipes, the automatic stabilizers, the mechanisms and rules applicable to financial markets in normal times, insufficient or misfit. At the same time, it is of the utmost importance, it is urgent to save lives, to guarantee a minimum welfare conditions for people all over the world. So that must be done at the expense of higher levels of public and also private debt, expansionary monetary policies, state aids, other instruments that may cause certain imbalance in what is the structure of financial regulation and financial stability. Well, in this context, it was a challenge, I believe, to reflect, to think about all these questions, all these aspects, because finding the right path to financial regulation is, of course, a major challenge under these current circumstances. As this conference comes to an end, I expect very vividly that next year we can be facing each other, not through a computer, but actually facing each other. Once again, I would like to express my warmest thanks to all the organizers and restate my gratitude to Professor Luís Moraes. Thank you very much.
Thank you very much, Paul. I mean, you are too kind. It's a great scientific pleasure to host the event, but thank you for your words. And we do have this commitment to continue with this project within the law faculty. I would finally give the floor to our two scientific partners in terms of regulators, the Securities Commission and Banco de Portugal, if Ana Paula Serra is still with us, as I believe she is. Starting with José Miguel Almeida and then moving to Ana Paula Serra. José Miguel Almeida, the floor is yours.
Thank you very much. Good afternoon to you all. First of all, I would like to congratulate Luís Moraes for this event. Again, this is a tradition, and year over year, it doesn't matter if it is online or physically, the conference is always very, very interesting with very good speakers. A second word, of course, to the speakers in this conference, which gave us a lot of food for thought regarding this topic. In a short overview, it was possible over this day to hear about how capital markets can be a key to the economic recovery. Also about the challenge for a more robust and resilient European Union in this field. Of course, over this period, we had the time to hear about what could be the status quo right now in the different financial sectors, being it in security sector, insurance sector, banking sector. However, it was quite clear that even if we heard the expression so far so good in a certain aspect, there are a lot of challenge ahead on time. There are elements that we need to keep on board to pay attention how the economy as a whole will evolve, having in mind this very, very difficult situation, besides the perspectives of global vaccination, maybe in the next year. We also discussed reforms in this area, reforms for future sustainability. Some points were very, very important regarding how we want and we can intervene in these fields to have a better and a stronger European Union in the fields of the financial areas. Also, very important, whatever is the evolution on this area, it is very important not to be complacent on the supervision, because with such challenges, the supervision is also a key element to be part of this process to evolve in the future. So it was a very, very interesting day. We have a lot of food for thought. And again, to end, my compliments to Luís Moraes and all the speakers. Thank you very much.
Many thanks to you, and Ana Paula Serra, your concluding words.
Thank you very, very briefly. So on behalf of Banco de Portugal, let me thank for this initiative. For us, it's really important to discuss these topics, and these are very useful as prudential, market conduct, resolution supervisors, because this is what we do on our daily life, and so it's good to hear from other stakeholders that also have policy reflection on how the framework can be improved. And my last words are about that. I think it's good. I think we are all happy to see that somehow the European institutional framework that we are building in a crisis that as the one that we are living seems to be producing some good results. And also the message that were heard about the convergence of supervisors and the importance, of course, of capital market integration. Thank you very much, and thank you, Luis.
Many thanks to both of you. I should emphasize, I will be very quick to wrap up and conclude. I should emphasize that a fundamental part of the project that we are trying to develop is to develop a triangle of dialogue, of critical dialogue between the academia, the regulators, and so the support of the Portuguese financial supervisory authorities is of vital importance, and the stakeholders. So I would like to conclude thanking you both heartily, José Miguel and Ana Paula Serra, but also Mário Centeno, Luís Máximo, and Gabriela Figueiredo Dias, who have intervened today representing the Bank of Portugal and the Securities Commission. And also to end on a logistical note, just to mention to our audience that in the next few days, we are publicizing in our website some of the materials of the conference and a part of the recording. Of course, in terms of the recording, that will depend on authorization of certain speakers, but we will try to organize some materials and also some summaries of the conference. And also stay tuned for our next initiatives, the one that I've mentioned to you with either the Ministry of Finance or the Secretary of State of Finance in January, but also other initiatives. Thank you all. Thanks to the audience and to our speakers. And muito boa tarde. Good afternoon to all. Thank you.
Goodbye.
Thank you.
Bye-bye.
Obrigado.
Bye. Bye.